So remember this trend over the last 30 years, the monopoly-duopoly situation? Where's the credit coming from? It's coming from the investment banks. This is the value chain or supply chain of liquidity in the trading and portfolio management industry. Who owns the narrative? What's the perfect retail broker to lend money to? One that peddles the narrative. Why? Because the investment bank can lend the money and make money out of it forever. So it's starting to add up. There's a monopoly-duopoly situation with exchanges and investment banks. Who are the biggest clients of exchanges? Investment banks. More on this later. But smart money and dumb money. This is why we labeled smart money on the professional side, investment banks, prop desks, dumb money on the right-hand side as the retail traders. Smart money understand how the financial markets work. They understand conflict of interest. It's professional trading 101. It's the stuff you get taught in your first couple of months at Goldman Sachs or any firm. That's good. They avoid trading in the way that other participants in the market who have conflict of interest want them to. They avoid it. And they do everything in the opposite way to the way retail traders do it. What do dumb money do? Believe everything they're told and rely on the infrastructure provided to them by financial market participants with conflict of interest. Believe that the infrastructure has been built for their benefit when it's actually been built for the opposite purpose. They trade in the way that they're told to trade, and they do everything in the opposite way to the way professional traders do it. But there's a catch. We talked about it earlier with the non-farm payrolls example. That's very typical. Smart money requires dumb money to exist. Who's supplying the credit facility? The investment banks. Who's the perfect broker? The one that peddles the narrative. Who's the perfect client? The client that believes the narrative. And it creates the negative feedback loop, and the professional traders win. We can also add hedge funds and pension funds into here. So in the grey box on the left, hedge funds are smart money. They're basically exactly the same as investment bank prop traders. Pension funds are slow money. They're investing over a long time. But the key here is they are the market participants that are on the professional side, and they are the biggest clients of investment banks. And combined, investment banks, hedge funds, and pension funds are the biggest payers of exchange fees on the planet, and two companies own 90% of the order flow on all exchanges in the world. It's a monopoly. So what you're looking at, ladies and gentlemen, on the left-hand side is Wall Street. And if you don't think they all work together, you've got your head up your ass. 6 or 8 investment banks control 90% of the volume. And everything on the right is dumb money and the inversion narrative. So everything we've discussed regarding the structure of the industry outside the US actually applies in the US too, but the CFDs were banned in the US in 2010. So what's happened since? Retail traders have been moving more towards trading options in the US. So they obtain their leverage through essentially implied leverage or implied volatility through trading options. If you wanted to actually trade normal physical assets in the US, the margin requirement is pretty high. So you don't get much leverage. You'd have to, it would be 33 to 50% margin requirement overnight. So 2 to 3 times leverage. And why do you think it's restricted in that way? They banned CFDs and that replaced it. And then everyone's going for options to get leverage. Index, Forex, and commodity futures, there's lower margin requirements, but the tradable set is pretty small, as in your amount of opportunities to make money because of the amount of contracts or assets you can trade is very low. So it's about 60 contracts, typically on a retail brokerage platform. And that compares to potentially 42,000 stocks. So your tradable universe is really small. And this is why options contracts have become very popular in the US, because retail traders can deposit less margin and get potentially much higher return if they make money through trading the option of an asset. And this is obviously a totally separate class in terms of options, but the two most important variables to consider with an option are theta, so time decay, and volatility. Theta, you have to be right by a certain date. Options adds this other element to a trade whereby you're not just long something and you can be long forever. You have to be right by a certain date. Otherwise, your option expires worthless. Volatility. Why is volatility important? Well, the more volatile something is, if volatility goes up, there's more opportunity to lose or make money. Well, risk and opportunity in the asset. So what happens when volatility gets bid up? When volatility goes up, options become more expensive. And retail traders don't understand how to calculate volatility and opportunity properly. So they always, for example, go long something and buy the asset at a level of volatility that doesn't even exist in the real market. So the odds are always massively against them. So what happens in the US is the vast majority of options expire worthless. Retail traders in the US use options as a proxy for simply going long or short the underlying asset without realizing that they have to be right by a certain amount of time, or the volatility that they're either going long or short can't be bared by the underlying asset's real volatility. But there's a very obvious question here. If 70% of options contracts in the US expire worthless, why don't you just sell options all day long? Easy money, right? Wrong. Selling naked options as a strategy constantly just to take money in, as in to get an income, is super dangerous. Why? If you do that, it's basically like picking pennies up off the railway track. You're playing a very dangerous game. If you don't have significant amounts of money to bail yourself out when you get 1 in 10 wrong, you're going to blow up very, very quickly. Now, do the brokers know this or not? Of course. So if you go on the platform and start naked selling options a lot, the broker's going to just stop you in your account from doing it and ask you to put up significantly more amounts of margin to cover the potential for any crazy losses. You essentially have gap risk in your trades. So you sell a call option, hence giving the buyer the right to buy the underlying asset at a certain price before a certain date. You take in a few $100. Congratulations. Go to bed, wake up the next day, the company's been taken over for a 100% premium by one of their competitors, and you're bankrupt. So that's why it's not that straightforward. Just because 70% of options in the United States expire worthless doesn't mean just go into the market and start selling options every day to make an income. What people don't understand in the US is that buying an option relative to buying a stock or a commodity or an index, so buying an option on those products, there needs to be a marginal benefit in addition to owning the option than to just owning it outright. And if there's no marginal benefit, there's no point, because you have to be right by a certain amount of time. So the risk reward has to be much more favorable over the amount of time, and you have to see catalysts that the market doesn't see. And you have to trade at the right price. If you're not trading at the right price, the risk reward will never be in your favor. So again, this massive gap in education and understanding of how these things work exists in the United States. So the options class is a whole different class. But let's have a look at the inversion narrative. We already know what the incentives are, the conflicts of interest. These conflicts of interest lead to what we call essentially a front door to the industry of lies and bullshit. That's what the inversion narrative is. You're being told the opposite of reality and the opposite of truth. So you fall for the narrative and do everything that they want you to do. And these lies and the bullshit is extremely intricate in detail. You've got to have a very, very well-trained eye and understanding in the industry to recognize some of the things that are going on. What does the inversion narrative exist for? It exists so they get paid. And wealth is transferred from your pocket to theirs. It's that simple. First thing we'll look at, introducing broker agreements. This is infrastructure that was inside that chart that we saw of the industry, and we briefly mentioned it. The retail broker provides contracts to people called educators. And these contracts are called introducing broker agreements. Now, the broker has to do this. In every country where there's regulation, the broker has to provide a contract to somebody who is introducing people onto their platform. What do those contracts typically state? Whoever you put on the platform, whatever they pay us, every month we'll rebate you 25 to 50% of the money they pay us. So what does that mean? Conflict of interest. It means that the trading educator is incentivized by exactly the same formulaic process as the broker. So what do they want you to do? They want you to trade in the biggest size possible, as frequently as possible, and believe the inversion narrative, and lose. Now, in the US, this happens all over the rest of the world outside the US. In Singapore, they're banned. In the US, a trading educator can't get a percentage rebate. They'll get a flat rate. But the inversion narrative still exists. Why? If you get paid by the broker as an educator, whether it's a percentage or a flat rate, it doesn't really matter. The outcome is the same. What's the outcome? No, so let's say, for example, you got introduced onto a platform and the trading educator got paid $500 flat rate. Why does the trading educator care how much you trade? Because the broker is paying him and he's the broker's bitch. He works for the broker. And the broker will not work with an educator who doesn't push the inversion narrative. They won't even get a contract. They'll have their contract cancelled. So this is why when we look from the left-hand side to the right-hand side of the industry, those red arrows you see are essentially arrows of where the narrative is coming from and the power is coming from. Because all the way from the left to the right, every participant individually, as you continue across, is the bitch of the one next to them. Does that make sense? They won't even get the contract. The contract will get cancelled. And then the trading educator doesn't have a platform that they can introduce their students onto or their clients onto. So then they're lost. They don't have a business. Make sense? So think about it like this, right? If you're the brokerage company with 10,000 clients, okay, what did we look at before with marketing? 30 to 50% is spent to get more accounts in, to open more accounts than accounts are closing down, okay? What do IB agreements provide brokers? They provide them with distribution and marketing where they don't have to pay marketing dollars up front. So a trading educator is going out on their own dime, setting up events like seminars, webinars, stuff like this, teaching nonsense, introducing guys onto the platform. They pay commission. They trade as frequently as possible in the biggest size possible. Broker takes the money in. Hasn't cost the broker anything. And then a check goes back out every month, 25, 50%, or a flat rate to begin with in the US, but they won't work with anybody who doesn't push the inversion narrative. So what is it doing? It creates infrastructure that lowers their marketing cost. So the status quo must be maintained. So they don't like it. But there is a discussion to be had with brokers as to why there's a big positive for it. Why? Why is there a big positive?